Here's an example of a 1-minute scalping setup playing out. First, on the 15-minute chart, we can see that the price is trending below the 50 EMA. The market is consistently forming lower lows and lower highs, which indicates that the overall direction on this time frame is bearish. Therefore, we want to zoom into the 1-minute chart and look for short entries. We notice that a recent area of market structure acted as support in the past. After the breakout to the downside, this support has now turned into resistance, potentially offering us a chance to enter a short trade. We wait for the price to reach our trading zone and search for reversal signals on the 1-minute chart. Here, we see the market forming a double top. Once the price breaks below the neckline, the pattern is confirmed, and we can enter a short trade. Scalping strategies in trading involve taking rapid, short-term positions on volatile currency pairs using technical analysis and strict risk control. While they can offer frequent opportunities, they require quick decision-making, and small losses can build up if not managed properly. Nasdaq 15-minute time frame. The step 1 is to analyze the overall market structure and highlight the most recent order blocks. Looking at the chart, we can clearly see an uptrend supported by strong bullish candles. These movements created an imbalance and a break of structure. Based on that, we can mark this clean order block area, where price is likely to react and potentially give us a solid trading setup. Once the price reaches this order block zone, we move to step 2. Now we drop down to the 1-minute time frame and wait for a clear change of character, CHH, to appear. This change signals that price might be shifting direction. As soon as we notice the change of character, we identify and draw the new 1-minute fair value gap that forms from this movement. This fresh zone becomes our potential entry area. Next, in step 3, we use the RSI indicator on the 1-minute chart to look for divergence, which will help us confirm our setup. With the RSI added, we identify 2 points on the price chart, point A and point B, where price is making lower lows. On the RSI, however, points A and B show higher lows. This is a bullish divergence, suggesting that the momentum is shifting upward and confirming our potential long entry. Step 4 is placing the trade. We set our buy order in the 1-minute fair value gap, with a stop loss placed a few pips below the lowest point of the zone. To manage the position, you can secure profits by closing half at a 1-to-2 risk-to-reward ratio. This way, if the market reverses and hits your stop loss, your trade still ends up at break-even overall. For the second take profit, you can aim for the next significant structure level on the 15-minute chart. Alternatively, you can trail your stop loss, moving it just below each new higher low as the trend continues. Also, as price moves in your favor, you might get more opportunities. Every time the market forms a new valid order block or fair value gap and continues in the trend, you can look to enter again, with reduced risk. For example, price forms another bullish order block after a break of structure, so we place a new buy order there. Then again, another order block forms, and we repeat the process. Sometimes the price may not trigger all your planned entries. For instance, if it misses your pending order before moving away, and that's perfectly fine. One last tip. Only add these additional positions if you've developed enough skill and confidence. Always make sure that the risk on these extra trades is half the size of your original position. Also, avoid holding more than 3 open trades on the same analysis for the same pair. Here is a clear demand zone identified on the chart, and we are going to evaluate it to confirm whether it meets the requirements for a high-quality zone. Large candles in this area show strong buying pressure, and the move away from the zone is quick and decisive with no hesitation. The zone is fresh and being tested for the first time. The previous market structure has been broken, which is a clear sign of institutional participation. There is also noticeable space between the demand zone and the next significant level, giving the market enough room to move freely. Based on these factors, this is a strong institutional demand zone. Next, we switch to the 1-minute chart, with the 15-minute demand zone already plotted. At this point, we wait for the market to reach the zone. When the price touches it, we expect a reaction, a candlestick signal such as a rejection or a reversal pattern. However, this alone is not enough to take the trade. We also need confirmation in the form of a bullish MACD crossover. Here's how the setup develops. The market touches the demand zone and forms a bullish engulfing candle, showing buying pressure. However, the MACD line has not yet crossed above the signal line, so we remain patient. The MACD crossover is essential because it suggests that institutional algorithms are likely joining the upward move. Shortly after, the MACD line crosses above the signal line, confirming the buy entry. The trade is taken at the close of the candle that forms right after the MACD crossover. The stop loss is placed 5 pips below the 15-minute demand zone to give the position enough breathing space. The target is set using a 1.5 to 1 reward-to-risk ratio, meaning the target is 1.5 times the size of the risk. As the market moves upward, it reaches the target, making this a successful trade. To apply this method consistently, the process is simple. Identify a strong demand or supply zone on the 15-minute chart. Wait for the market to reach it and show a positive reaction such as a rejection or reversal, and finally, confirm the entry with a MACD crossover. This approach helps align trades with institutional activity, giving a stronger edge in the market. On this chart, we can clearly see a well-defined supply zone. The candles in this area are large and consistent, indicating strong selling pressure. Price moves away from the zone sharply and decisively, showing no hesitation. The zone is fresh and is being tested for the first time. We can also see that the previous market structure has been broken, which is a strong sign of institutional activity. There is clear space and imbalance between this supply zone and the next price level, giving room for price movement. This is a textbook example of an institutional supply zone. Large institutions rarely unload their full positions in one go. Instead, they distribute orders in portions, often placing limit orders at the same price level to sell more if price revisits the zone. This price area represents a level that institutions find favorable for offloading their positions. So, what typically happens when price returns to this zone? It often meets strong resistance and starts to drop. Now, let's add the MACD indicator for confirmation. As the market comes back to the supply zone, notice how the MACD line crosses below the signal line. This bearish crossover is a signal that institutional algorithms often act upon, confirming a sell opportunity. This combination is powerful because we know exactly where institutions have sold before and where their limit orders are likely waiting. At the same time, we have confirmation from the MACD, whose algorithms are signaling a bearish setup at that exact price level. Looking at the chart, we can see the market reacting to the supply zone, respecting institutional orders, and moving downward. Thanks for watching. If you found this video helpful, don't forget to like and subscribe to the channel for more trading insights and strategies. Your support helps us grow and continue delivering high-quality content. See you in the next video.